President Biden drops out of November's election, increasing the uncertainty for US investors. Welcome to Market Insight, I'm Thomas Warner. The withdrawal of President Biden over the weekend makes a Trump victory now appear slightly less likely. Online betting site PredictIt shows pricing for a Trump win down 4 cents to 60 cents, with Kamala Harris climbing 12 cents to 39. So what do these changing odds mean for investors ahead of November? With me to share his thoughts is Young-Yu Ma, Chief Investment Officer at BMO Wealth Management US. A very warm welcome to you. So tell us, are investors hitting pause on the Trump trade?
I think that's what's likely to happen here, not just this week, but probably over the next few weeks, because there is a high dose of uncertainty. And even those betting odds numbers that you cited could change quite meaningfully depending on what the dynamics are. There's still a VP pick to be had. There's still election themes that are going to be pushed forward, new ones versus the old ones that previously existed. So there's a lot of uncertainty now, and it doesn't really make sense probably for investors to take big positions now amid this uncertainty.
Uncertain times indeed. So let's focus a little bit more on the potential longer-term outcomes. What difference do you think either a Trump or a Democrat victory would make in theory?
That's a great question about the longer-term implications. I would say probably the biggest long-term indications relate to the size of the debt and deficits that are in the U.S. and a sweep in either direction, although the only sweep that's really on the table as a possibility now is a Republican sweep, would probably add to those deficits, the size of those deficits, which are already quite enormous. And that does have long-term implications for the U.S. economy, for interest rates. So a lot of things can be reversed on a change of administration after 4 years, a change of policies. But once you get those debt and deficits dynamics in place the way they are and the way they could be even more significantly, that is actually harder to reverse. So we do think that's probably the biggest long-term implication that we have here.
Have we received any kind of implication or indication over the last 4 years that we know what sort of a presidential candidate Kamala Harris could be? Has she ever espoused any particular policy that would be relevant to the markets?
It will be interesting to see what comes out over the next couple of weeks. Certainly, she's been seen as a little bit more left-leaning than President Biden, and certainly topics such as women's health rights have been more front and center for Vice President Harris. And we think those will be pushed in the election because that is something that is quite distinctive between the parties. But otherwise, some of the other areas remain to be seen in terms of what platform she's going to really promote in a very short period of time to try to win this election. So I think probably what would make sense for the Harris team is to really just pick a few issues and really try to drive them home rather than roll out a big broad-based platform where the opposition could perhaps nitpick at certain areas.
Returning to this week now, we are expecting some solid results from Alphabet tomorrow, among others. Last week was characterized by investor rotation out of tech, but you say in your notes that you're still positive on technology. So do you think there's a bit too much fear around the sector at the moment?
Well, in the short term, it's hard to know exactly how it's going to play out. And there is certainly political concern as well with former President Trump having certain companies, at least, making a lot of comments about the prospects or about the having too much strength in certain companies. So we do think that overall the sector is quite healthy. We think there's a lot of growth in the sector. Some of the negativity last week was perhaps overdone, and ultimately earnings and growth are going to rule the day. But the political implications are still in the background, and that's not going away anytime soon. So there's probably a cloud over the sector, but we do feel positively about the sector in the medium term.
And you're also on record as saying that weak jobs numbers for July and August could prompt a double rate cut from the Fed at its September meeting. Very intriguing prospect. What's the thesis there, and just how likely do you think that it is?
Well, the market isn't pricing this in hardly at all right now, but we think it's more likely than the market's odds right now. We think where things stand now, it's probably only about a 30, maybe 35% chance. But if we get a weak jobs report in a couple of weeks, the July jobs report, that would really shoot up those probabilities much higher, we believe, because we've already had a relatively weak report last month. We're seeing weekly initial unemployment claims start to rise. And inflation being as low as it is in the downward trajectory, we think that's firmly in place. And right now, the risk to the labor market is actually greater than the risk to inflation resuming an upward trend. So we think the Fed has latitude. Should it be needed? Whether it will be needed will depend on probably the next 2 months of jobs reports. And the trend is definitely for weakening or softening right here.
Yung-Yu Ma, Chief Investment Officer at BMO Wealth Management US. Thank you very much indeed for your time today. And that is your market insight. You can watch more videos on Reuters.com.